Let's talk markets this morning. Joining us right now is Ed Yardeni. He's the president of Yardeni Research. And Ed, you are joining us on a morning where we have seen new highs once again for both the Dow and the S&P 500. What do you think of this rally that we're on? What kind of legs does it have? And what would you tell people in terms of where they should invest right now?
Well, I think they should stay invested. It's hard to tell somebody who's been in cash to get into this market right now. Things are not exactly cheap, but clearly those who are getting into the market are going into the small and mid-cap stocks, which have been relatively cheap, and that's fine. And then I think people are also going into the S&P 493, which are cheaper than the Magnificent Seven. But all in all, I would stay invested. The outlook remains fairly upbeat. Clearly, there's risks out there, but the economy has proven itself to be remarkably resilient. I think interest rates have normalized. I don't think the Fed really needs to lower interest rates. And meanwhile, the outlook, I think, is going to be somewhat bumpy with regards to issues of tariffs. But tax cuts and deregulation should be good for earnings.
So the entire idea of, don't fight the Fed if the Fed is continuing to cut rates, that has been one thing that has driven this market. You think the baton's been handed off at this point to maybe a more business-friendly administration that's coming in, and the idea that corporations are going to be able to continue to earn pretty significant amounts of money?
Absolutely. And not only that, I think that we are still in the early stages of a productivity boom. Productivity really was extremely low back in 2015. It was almost down to zero. And we've seen it go from 0.5% to about 2%. So we've seen a quadrupling of productivity since 2015. And I think productivity growth can go up to 3 to 4%, which sounds delusional. But the reality is we've had productivity booms in the past, in the 60s, in the 90s, and they also showed productivity going to 3 to 4%. And this productivity boom probably has more going for it because the technologies that are out there lend themselves to being used by many more business kind of applications than we had even in the 1990s.
You think this is entirely AI driven, or we're still pretty early in the AI run on things? Right.
No, Becky, we've been calling this the roaring 2020s since the beginning of the decade, and so far so good. And it wasn't based just on AI. It was based on cloud computing. It was based on automation, robotics. There's a lot of moving parts here on the technology revolution, and they all coming together. But I think the key driver is a shortage of skilled labor, and technology is able to augment the productivity of workers. That allows for wages to rise faster than prices, which is actually what's been happening for the past year and a half. So all in all, I think productivity is really the story that's driven the economy so far during the roaring 2020s, and I think it'll continue to do so up ahead here. And I think deregulation helps, tax cuts help. We'll see where the tariffs go. They could be that bump in the road along the way, but I think we're heading to 7,000 on the S&P 500 by the end of next year. 8,000 by the end. Well, 7,000 to 6,000 is doable in my opinion, and then 10,000 by the end of the decade. So that's my Thanksgiving gift to you all.
Okay, we'll take a prediction like that as we head into the holiday. Ed, you're the second person in an hour who's told us that we should be looking at the other 493 stocks. Peter Bookvar was on with us earlier saying the same thing. How hard is it to find bargains there? I mean, it seems like a pretty common mantra that people have been saying for a little while now. Look at those other 493.
Well, I guess my view is when you look at your portfolio, think of every company as a technology company. They either make it or they use it. If they don't use it, they're going to be a competitive disadvantage. And so I think there's a tremendous amount of pressure to use technology. And it's not just pressure. I mean, it pays off. And so I think there's still opportunities in technology, believe it or not, and in communication services. But in the rest of the market, I think financials are still have opportunities, industrials, consumer discretionary. I think there's some clunkers, like healthcare is going to be challenged by RFK and Dr. Oz. We'll see how that plays out. And materials and energy are being challenged by a fundamentally weak outlook for the Chinese economy as well as the European economy.